Hello everyone, welcome back to our channel and welcome back to this brief video update. In this update, we wanted to share with you Pershing Square's IPO outcome and the pricing of the founder and reputation. From microphone to market. Bill Ackman's dual IPO paired a $5 billion raise for Pershing Square USA, a closed-end equity fund with the public listing of his management company, Pershing Square Inc. Both outcomes reward analysis. The fund came in at half its reported $10 billion target and opened roughly 18% below the offering price. The management company traded up sharply on its first day and continued to climb through the week. The divergence here is the story. Institutional and retail capital price a discretionary fund and the fee stream royalty differently, even though the same operator sits behind both. The April Capital Compass and Ackman social media governance argued that the founder reputation would manifest as a measurable cost of capital signal in the IPO. The Pershing Square outcome confirms that hypothesis with greater precision than expected and offers a template for institutional allocators evaluating other founder-led public capital structures. With this context and background, let's talk about the expectation gap. Going into the week, Pershing Square USA was reportedly targeting up to $10 billion of capital. The closing figure was approximately half that. Ackman's narrative had positioned the firm as a generational opportunity for retail investors to access permanent capital institutional strategy at scale, supported by a social media reach of more than 2 million followers on X. The reach did not translate into capital by the time the pricing was set. Several anchor commitments had reportedly been pulled and the offer was repositioned as a more selective raise. The mechanics of the deal also required a structural sweetener. Every 5 shares of closed-end fund came bundled with 1 share of the management company. That feature, while economically rational from issuer's perspective, is itself a tell. A founder-led product at this profile would not normally require an equity sweetener to clear the market. The sweetener is a discount mechanism by another main, transferring upside in the management company to fund subscribers in exchange for committing capital to a vehicle that the market was otherwise pricing cautiously. Let's also try and understand the discount mechanics and reading the spread. After the underwriting fees, the fund's net asset value started at approximately $49 per share. By Wednesday's close, the price had fallen to around $41, an immediate 18% gap to the $50 offering price. By the week's end, the price had recovered modestly to approximately $43, leaving an estimated 12% discount to the net asset value. Closed-end funds typically trade at discounts to portfolio value because investors cannot redeem shares at par. They must sell into the secondary market where supply and demand price the equity claim independently of the underlying assets. A discount in this structure is therefore partially mechanical, and the broader closed-end fund category has traded at persistent discounts for several years. But the magnitude of this particular spread is read more skeptically given the operator profile, the marketing intensity that preceded the deal, and the absence of any underlying portfolio drag. The fund is, on day one, almost entirely cash. The discount is also on the tax and capital deployment. Every dollar that Ackman invests through the fund starts roughly 88 cents of priced equity behind. Layered on top of 2% annual management fee, the compounded hurdle to outperform a low-cost index alternative is meaningful. And the burden of that hurdle falls entirely on portfolio selection. Next, let's talk about the two-vehicle divergence. The more interesting signal is the management company. Pershing Square Incorporated opened around $24, traded to roughly $30 in the after hours on Thursday and closed Friday near $38, implying a market capitalization of roughly $15 billion. Strategic investors who paid $26.25 per share 2 years ago are now meaningfully in the money. Ackman himself, who controls approximately 180 million shares, has seen his personal stake mark to roughly $7 billion on the public listing alone. The divergence between the fund which traded down and the management company which traded up is the governance-relevant data point. A management company is structurally a fee stream royalty. Its earnings are protected by contract, the management fee is locked in regardless of the fund performance in any given year, and the 17 times multiple the market is currently assigning to the base fees treats those fees as a stable growing revenue. A discretionary investment fund is the opposite. Its value depends on continued alpha generation and its capital can underperform in any given period without recourse for the shareholders. Investors paid a premium for the contractually protected business and a discount for the discretionary one. Both the prices are correct. Both reflect the same governance read on the same operator from different structural angles. The market is willing to pay for the brand when it sits inside a fee contract and demands a discount when it sits inside a discretionary capital allocation mandate. So, when we are talking about the retail following fallacy, the most overstated assumption in the run up to the deal was that the social media following converts efficiently into investable capital also. 2 million followers on X represented an audience or commentary, not a mobilized retail base. Several possible explanations apply out here. Followers may not have understood the mechanics of a closed-end fund offering, may have sold into early weakness rather than holding through the discount phase, or may have simply engaged with Ackman's commentary without any intention of allocating capital. The implication for other founder CEOs contemplating similar capital raises is that the audience and the ownership are different markets. The pricing power of the former is far more limited than recent assumptions in the alternative asset space have suggested. Distribution infrastructure, for example, warehouses, registered investment advisor networks, family office introducers, remain the binding constraint on retail capital mobilization, and a social media following is a complement to that structure rather than a substitute for it. Now, that's all that we wanted to share with you in this update. Stay tuned in for our next one.